Good morning, members of media. Thank you for joining our virtual press conference in conjunction with the release of our flagship publications, Annual Report 2020, Economic and Monetary Review 2020, and Financial Stability Review second half of 2020. Without further ado, I would like to hand over the floor to Governor to start the press conference. Over to you, Governor.
Thanks, Faz. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh dan salam sejahtera. Setelah lebih daripada 1 tahun ekonomi negara dan global bergelut dengan pandemik COVID-19, cabaran yang dihadapi masih belum selesai. Walaupun terdapat beberapa segmen yang masih terjejas, secara amnya keadaan ekonomi negara semakin pulih dan prospek pertumbuhan juga telah semakin baik. This morning, I will review recent economic developments and provide an outlook for 2021. I will also discuss the policies needed to secure the economic recovery and enable Malaysia to emerge stronger in the post-pandemic future. The COVID-19 pandemic triggered a deep global recession in 2020 as many countries implemented containment measures to control the outbreak. As a result, governments and central banks implemented significant policy support to cushion the adverse impact on growth. In 2021, global economic activity is expected to recover. This will be supported by, first, the easing of containment measures amid the mass rollout of vaccines. Second, recovery in private sector demand in major economies. Third, improvement in cross-border trade in goods and services. And fourth, continued accommodative policies. On the domestic front, the Malaysian economy contracted by 5.6% in 2020 amid the challenging economic environment. Similar to other countries, our growth was affected by the sharp contraction in global economic and trade activities, as well as domestic measures to contain the COVID-19 epidemic. Nevertheless, the sizable stimulus packages announced throughout the year provided much-needed support to growth. These include cash transfers to vulnerable households, wage subsidies, and financial measures to ease cash flow of households and businesses. The economic fallout from the COVID-19 pandemic was most evident in the labour market, with the unemployment rate rising to a 30-year high of 4.5% in 2020. In response, swift and coordinated measures were deployed to cushion the economic shock and avoid permanent scarring in our economy. Monetary policy was adjusted to support growth, and liquidity measures were introduced to preserve orderly market conditions. This complemented the various fiscal packages, especially to help those who were directly affected by the crisis. During this period, the bank also implemented financial measures to provide immediate relief to households and SMEs, while expanding lending facilities to support productivity and efficiency improvements of SMEs in strategic sectors. At the same time, other longer-term measures were also implemented to help workers and businesses adapt and lay the foundation for a more durable recovery. Looking ahead, the Malaysian economy is projected to grow by 6 to 7.5% in 2021. With the reimposition of containment measures from 13 January, will affect growth in the first quarter of this year, growth is expected to improve from the second quarter onwards. Overall, economic activity is expected to be supported by both external and domestic factors. These include the improvement in external demand, especially from our major trading partners, normalization in domestic economic activities as the containment measures are relaxed and the economy gradually reopens amid rollout of the vaccination program. All this will contribute to further improvements in the labour market conditions. At the same time, policy support remains available for both households and firms. The National COVID-19 Immunisation Program, which commenced in February 2021, is expected to provide some support to the economy. It will also help to facilitate a normalization of economic activity as consumer sentiments improve and domestic tourism and recreation activities gradually resume. For the rest of 2021, we assume that health-related standard operating procedures are expected to remain in place. Interventions are expected to be targeted, minimizing disruption to economic activity. Nevertheless, international borders are expected to remain closed in 2021 to minimize risk of imported cases of COVID-19 or its variants. Given Malaysia's trade openness and integration in global value chains, the improvement in external demand will benefit our economy. Growth in Malaysia's key trade partners, particularly China, the US, and Euro area, are expected to rebound in 2021. These economies collectively account for around 40% of Malaysia's total exports. This will translate to higher demand for Malaysia's goods, benefiting in particular our manufacturing sector. The increase in production is expected to lend further support to the labour market, as about 70% of manufacturing employment in Malaysia are in export-oriented industries such as E&E, refined petroleum, and chemicals. A key driver to the improvement in exports and manufacturing activity is the global tech upcycle. The COVID-19 pandemic has accelerated the structural shift towards digitalization. This is largely driven by widespread work-from-home arrangements, which spurred greater demand for IT infrastructure, cloud computing, and smartphones. All these trends continue in 2021. Global demand for E&E components, such as semiconductors, are projected to remain robust. Being a key player in the E&E global value chain, with an established base of key firms already operating in the country, Malaysia is poised to benefit from these trends, particularly in the production of semiconductors and LED components. Apart from external factors, Malaysia's 2021 growth will also be lifted by higher domestic production. This reflects additional production from existing and new manufacturing facilities and the operationalization of new natural gas and petrochemical facilities. Agriculture output is also expected to improve in the second half of the year. This is driven primarily by higher oil palm production due to better weather conditions and expansion of mature plantation areas. In addition, the continuation of large infrastructure projects such as the ECRL and Pen Borneo Highway, as well as small-scale construction projects as announced under Budget 2021 and Pemekasa Stimulus Package, will lend further support to growth. For example, the ECRL project, which was 20% completed at the end last year, is slightly ahead of schedule and is targeted to reach 30% completion rate by end 2021. These projects would contribute to a strong rebound for the construction sector in 2021 after a significant contraction last year. On the demand side, private consumption is projected to rebound up to 8%, supported by several factors. First, containment measures, which severely limited spending last year, is expected to be less stringent in 2021. Consumer sentiments are also expected to improve gradually, mainly towards the second half of this year, with higher rates of vaccination. Together, this would lift spending. Already, we are seeing improvement in the latest mobility and spending indicators following recent easing of movement restrictions. Second, overall household spending will be fundamentally driven by the gradual improvement in labour market conditions. Let me start off with wages. The outlook on wages remains relatively positive, as reflected in the annual salary survey by the Malaysian Employers Federation. Employment conditions will recover gradually as economic activity picks up in 2021. Trend-wise, despite some temporary weakness in the first quarter, labour market conditions are expected to recover thereafter. Both unemployment and underemployment rates are projected to gradually decline for the rest of the year. The latest average daily jobless claims data shows that the impact of recent movement restrictions on the labour market has been less severe compared to the second quarter of 2020. The increase in new job placement rates also indicate encouraging signs of continued hiring in 2021. Notwithstanding this, some households will remain affected by the pandemic, and this is where the continued availability of policy assistance, such as the wage subsidy and hiring incentives, will help safeguard jobs and incomes. Other measures such as the iSINA cash withdrawals and direct cash transfers are also available to support the vulnerable groups. Finally, we have seen consumers shifting rapidly to online shopping throughout the pandemic, with its growth increasing by almost twofold by end of last year. And this trend is likely to persist going forward. While it remains a relatively small share of consumption at present, online retail has and will continue to help cushion the lower spending in physical stores, particularly when targeted movement restrictions are in place. A global consumer survey, which includes Malaysia, indicates that a higher share of consumers intend to continue spending online post-pandemic. In response, firms have also been adjusting their business model to the rapid adoption of e-commerce and digital payment solutions. Investment activity is also expected to improve amid better global and domestic demand conditions. It will also be supported by the realization of approved investments, particularly in the manufacturing sector, continued implementation of major transport infrastructure projects, investments in digital infrastructure, in particular the implementation of My Digital initiatives, and the ongoing government efforts to attract quality investments and initiatives to improve ease of doing business. In this connection, I am pleased to announce further liberalization of the bank's foreign exchange policy. In recent years, the bank has progressively liberalized its foreign exchange policy to improve business efficiency and the private sector's management of foreign exchange risk. Recognizing Malaysia's vital position in the global supply chain and to foster a more conducive environment in attracting quality investments, the bank is pleased to announce the following measures. First, the export conversion rule is lifted. Going forward, resident exporters will be free to manage their own export conversion according to their foreign exchange cash flow needs. Second, exporters can settle domestic trade in foreign currency with other resident corporates operating in the global supply chain. Third, exporters are allowed to net off export proceeds against permitted foreign currency obligations. This flexibility enhances business efficiency and cash flow management for exporters. Fourth, exporters can repatriate their export proceeds over a period beyond 6 months in exceptional circumstances, such as when their buyers are in financial difficulty. Lastly, corporates are now allowed to undertake commodity derivative hedging directly with non-resident counterparties. All these measures will be effective from 15 April 2021. Overall, in terms of the growth prospects, all economic sectors are projected to record positive expansion in 2021. This is supported by stronger external demand and the gradual resumption in economic activities as containment measures are relaxed. On the demand side, all components are expected to expand with domestic demand as the anchor of growth. Headline inflation is forecasted to average higher in 2021 between 2.5% and 4%. This is due mainly to the expected higher global oil prices and the lapse in the electricity tariff rebate introduced last year. In terms of trajectory, headline inflation is expected to rise further in March and is anticipated to temporarily spike above 5% in the second quarter of 2021. A key assumption is that RON 95 retail fuel price remains at the price ceiling of RM2.05 per litre in the second quarter. The spike is driven by the lower base from the low domestic retail fuel prices last year, which averaged at RM1.37 per litre. This is temporary, and headline inflation is expected to moderate thereafter. The risk of second-round effects is low amid muted wage pressures. Moreover, underlying inflation is expected to remain subdued amid the continued spare capacity in the economy. Overall, the inflation outlook is subject to uncertainty, particularly movements in global oil and commodity prices. The balance of risk to the Malaysian economic outlook remains tilted to the downside. The main risks to the domestic economy are the developments surrounding the COVID-19 pandemic. This includes potential further containment measures should there be disruptions in the vaccine rollout globally or domestically and COVID-19 cases re-escalate. However, there are some upside potential to 2021 growth outlook, such as the higher than expected exports to major trade partners, pent-up demand following the lift of containment measures, and the stronger than expected impact from policy support. Turning to the financial markets, throughout COVID-19 crisis, rapidly evolving sentiments on the outlook for global economy has generated volatility in domestic financial markets. Nevertheless, domestic financial market conditions have remained orderly in supporting the economy. With interest rates at historical low level, retail investor activity is expected to be sustained in the near term as investors seek higher returns. Risks associated with this activity are assessed to be limited, given that it is not driven by borrowings. Going forward into 2021, the bank will continue to monitor and ensure the smooth functioning of domestic financial markets in supporting the economic recovery. Flexible ringgit exchange rate adjustments will continue to play a key role in ensuring resilience against external shocks, while the bank stands ready to manage any excessive volatility through two-way foreign exchange interventions. Orderly market conditions will continue to be supported by market depth and sound financial policies. This include a well-diversified investor base, greater avenues for investors to hedge risk exposures, and a resilient and well-capitalized banking sector. Together, these factors will help to ensure uninterrupted financial intermediation to the economy. Credit flows improved towards the end of the year, as reflected by higher loan disbursements to businesses and households. Loan disbursements to SMEs increased, mainly for working capital purposes. For households, loan disbursements, particularly for the purchase of homes and cars, have increased above the historical average in the last 2 quarters. In 2021, accommodative financing conditions and measures would continue to support loan demand and supply. In particular, total loan applications and approvals have increased above the historical averages in the second half of the year. Loan growth in 2021 is also expected to be broadly sustained, in line with the loan growth projection by banks. On monetary policy, the OPR were reduced by a cumulative 125 basis points last year, which will continue to provide stimulus to the economy. Given ongoing uncertainties surrounding the pandemic, the stance of monetary policy going forward will continue to be determined by new data and information. In view of the higher headline inflation being driven by supply-side factors, monetary policy, as a demand management tool, will not be appropriate to manage this. Monetary policy in 2021 will remain accommodative to support the economic recovery while ensuring price pressures remain manageable. The bank also remains vigilant against a build-up of financial imbalances. The bank has been and will continue to utilize its policy levers as appropriate to ensure the right mix of policies in supporting a sustainable economic recovery. Monetary policy will continue to be complemented by the bank's policy tools such as liquidity operations, appropriate regulatory and supervisory measures, establishments of targeted financing facilities, as well as other financial sector policies. The financial sector was also not spared from the economic and financial impact of the pandemic. Despite improvements in businesses and households' debt servicing capacity, stringent lockdown measures were imposed in the second quarter last year, banks will continue to face challenges from the weaker credit risk outlook amid uncertain economic growth prospects. Our assessments show that a higher proportion of loans have been classified by banks as Stage 2 under MFRS 9, or in other words, in layman's terms, loans with increased credit risk. Given the weaker credit outlook, banks have also set aside much higher provisions for expected losses, which rose by more than 40% in 2020. This resulted in lower earnings, with the banking system's return on equity declining the most since the Asian financial crisis to 9.2% in 2020. Nevertheless, downward pressure on future earnings are expected to be cushioned by the preemptive provisions made by banks in 2020. This is important as the sustained earnings performance of banks will ensure that banks continue to have strong buffers to support credit flows to the economy. Despite the highly challenging operating environment, both the banking and insurance sectors have remained resilient. Financial institutions have sustained their strong capital levels. Excess capital buffers to absorb any potential losses above regulatory minimum remain sizable and amount to about 126.7 billion ringgit for banks and 36.1 billion ringgit for insurers and takaful operators. Banks also continue to record healthy liquidity positions with the liquidity coverage ratio at 148.2%. This will ensure banks' ongoing ability to support intermediation activity. The bank's latest macro stress test affirmed the resilience of our financial institutions. In this exercise, the bank explored two hypothetical scenarios with recovery paths that are significantly weaker than the bank's latest baseline growth forecast. Adverse Scenario 2, which is the most severe scenario, assumes an L-shaped recovery, with GDP recording negative growth in 2021 and remaining below pre-pandemic levels even by end 2022. Of significance, the economic contraction under this scenario is worse than the Asian financial crisis, with sharper dips and a slower return to pre-crisis levels. The stress test shows that capital levels of both banks and insurance sectors remain comfortably above regulatory minimum, even under the most adverse economic scenario. This reflects the strong loss-absorbing capacity of the financial system and its continued ability to sustain support for the economy. Underpinned by this strength, banks continue to extend support to those that continue to be affected by the COVID-19 pandemic. To date, more than 1.5 million borrowers have applied for repayment assistance with an approval rate of over 95%. The repayment assistance continues to be available to ease cash flow constraints for many borrowers and therefore avoid premature impairments and foreclosures as well as permanent economic scarring. Because of the systems, the processes and resources that banks have put in place over the past year, banks are also operationally much better prepared to support borrowers who still require repayment assistance. This is further complemented by multiple channels for borrowers to seek help and advice. Borrowers can approach My KNP, Link, and AKPK for assistance. Therefore, I would urge borrowers to make use of the various channels available if they continue to experience financial difficulties. For SMEs, Bank Negara Malaysia continues to offer targeted financial support. This is meant to complement broader policies by the government and the financial institutions in supporting the economic recovery. On top of providing relief to economic sectors impacted by COVID-19, facilities under Bank Negara's Fund for SMEs, such as the automation and digitalization facility and the agro-food facilities, were also developed in 2020 to encourage financing that would increase the productivity and efficiency of our SMEs in strategic sectors. The total allocation of 23.1 billion ringgit under Bank Negara's funds, however, remains a small fraction of the amount of SME credit from banks at only 4% of total disbursements by FIs to SMEs. Importantly, bank financing was channeled to new customers and underserved segments in 2020. 33% of total SME approvals by banks were new to bank customers. More young SMEs, that is those established not more than 3 years, have had their applications approved by banks, with a 46% increase in terms of the number of accounts approved. The bank's publication also include in-depth analysis on economic issues and other areas relevant to the bank's mandate. A key theme across our box article this year are the structural reforms to enable Malaysia to emerge stronger from the pandemic and seize new growth opportunities. These reforms will place us in a better position to secure a durable economic recovery with a resilient workforce, innovation-led growth, as well as social protection for those in need. Allow me to elaborate a few of these policy imperatives in the subsequent slides. On the Malaysian labour market, prevailing structural issues are weighing in on our future job and income prospects. First, the low-cost production model suppresses wages and productivity enhancements. Second, high-skill job creation has been insufficient to keep up with the entry of fresh graduates. And third, there has been skills mismatches between workers and industry needs. Notably, as a result of the pandemic, vulnerable segments of the labour market have been more affected. In particular, women, non-standard workers, and youth experience higher unemployment losses. Going forward, the anticipated uneven recovery and acceleration of key trends surrounding digitalization and technological adoption may exacerbate these issues. We discuss this in further detail in a future article in the EMR titled Getting the Great Reset Right, Structural Labour Market Issues in a Post-COVID World. Looking to the longer term, the crisis has also provided Malaysia with an opportunity to reset and build stronger fundamentals on multiple fronts. In the labour market, comprehensive policies are needed to support recovery from the crisis and prepare the workforce for the future of work. Foremost are continued efforts to catalyse economic transformation, particularly through improvements to the investment ecosystem, which are needed to attract and facilitate investments that can create high-skill jobs. Labor-related policies to improve training and matching mechanisms, as well as enhance workers' resilience, should complement these efforts. It is also timely for Malaysia to embark on reforms that emphasize innovation-led growth. The 3Ds of reforms to accelerate digitalization, rethinking downstreaming, and reduce distortion will reset Malaysia towards higher quality growth. Being forward-looking in a post-pandemic world is crucial and will require greater policy adaptability and flexibility to benefit from the rapid shifts in global trends. Digitalization, as we are aware, is key for the future economy. It is therefore crucial to accelerate digitalization in both the public and private sector to catalyze an innovation-led growth. Besides strengthening ecosystem enablers and business digitalization, efforts should also be focused on scaling up the local tech industries and attracting high-value investments into Malaysia. Another key area that is gaining global momentum is on the green economy. We have seen the extent of the severe effects and costs of the pandemic on livelihoods and lives. Unlike the pandemic, where the rollout of vaccines provide effective mitigating solutions, the damaging effects from climate change events are irreversible, with far-reaching consequences on the economy and society. Concrete actions, therefore, need to be taken now to ensure an orderly transition that will minimize economic and social dislocation. This should start with the development of clear national aspiration that is supported by coordinated strategies and supporting key infrastructure. These include establishing the legislative framework that specifies greenhouse gas emission targets by economic sectors and the specified timelines, requiring disclosure and reporting by public and private sectors, with the necessary data infrastructure to facilitate cost-efficient data capture and access by various stakeholders. These measures will complement ongoing efforts by the bank to strengthen the framework for assessing and managing climate risks in the financial sector. Finally, what the crisis has shown is there is room to enhance protection or safety nets for vulnerable groups in the society. Therefore, to safeguard against present and future socio-economic vulnerabilities, reforming Malaysia's social protection will be key. These reforms will build the foundation to future-proof Malaysia's social protection system and enhance access to better opportunities. Reforms should be comprehensive and cover all three pillars of social protection, which includes social safety nets, social insurance, and active labour market policies. The gaps in each pillar range from fragmentation of policies, effectiveness, inadequacy, and sustainability. This should be addressed holistically with strategic enhancements guided by an overarching social protection reform roadmap. Let me briefly report on the bank's financial position. For the year 2020, the financial position of Bank Negara Malaysia remains stable. As at the 31st December 2020, our total assets amounted to 448.04 billion ringgit, and out of a total net profit at 10.24 billion last year, 6.24 billion will be transferred to the General Reserve Fund and 4 billion will be paid as dividend to the government. Let me now conclude the briefing. The Malaysian economy is projected to rebound and grow by 6% by between 6% to 7.5% in 2021. This recovery will be driven by improved external demand, pickup in investment and production activities, and support from policy measures. The balance of risk is tilted to the downside, arising mainly from developments surrounding the COVID-19 pandemic. Apart from fiscal measures, monetary policy remains accommodative and financing conditions are supportive of growth. As economic growth becomes more entrenched, the rebuilding of overall policy space, including monetary, financial, and fiscal buffers, is necessary to ensure that we have adequate room to maneuver if the economy faces another shock. At the same time, structural reforms related to the labour market, innovation, and social protection will be critical to ensure that Malaysia emerges stronger in the post-pandemic future. Most importantly, this will allow us to achieve the kind of quality growth that typically defines a high-income economy, with several critical hallmarks such as more sophisticated and diversified industries, high standard of living, and a first-class civic society with strong value systems. Last but not least, on behalf of all the staff at Bank Negara Malaysia, I would like to extend our utmost gratitude to all our frontliners who have been working tirelessly to keep us safe since the onset of the pandemic. Let us continue to practice SOPs diligently. On our part, the bank will remain focused on discharging our mandates to foster enabling conditions for a sustainable recovery in the economy. My team would be happy to sit down and explain in greater detail any part of our 3 reports if needed. I will now take on questions from the press. Thank you.